It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, 4 a.m. in Sydney, and 9 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID live stream. Series 27, episode 6, that makes for an aggregate of episode 162 starts here. And we begin with disaster averted at the New York Stock Exchange, thanks to the FBI, as a terror plot has been solved. A Florida man has been charged, and no, none of the people who are suspects are those involved on that particular picture we're showing at the moment from the floor of the New York Stock Exchange, where, of course, I wonderfully had the experience of ringing the bell on July the 5th. Glad to see that the world's capital of capitalism remains absolutely intact, and well done, the FBI, for managing to see off the terror threat. Weird news of the week, ladies and gentlemen, where the London Stock Exchange is being pilloried for its failures to grow its own market in London. They're going to help build the Nouakchott Stock Exchange. Nouakchott, that's the capital of Mauritania, ladies and gentlemen. Sometimes you just can't make this stuff up. Wikipedia notes the economy of Mauritania is still based largely on agriculture, slave labor, and livestock. GDP per head is at under $2,500. Gosh, I think it's fantastic that the government want to open a stock exchange in the capital, Nouakchott. Presumably they're not going to be listing any slave-related enterprises, I sincerely hope. But I'm bewildered. Just what on earth can the LSEG offer in truly practical assistance to this absolutely frontier market? We wish the Nouakchott SE every success, but we just can't fathom what benefit they're going to derive from the London Stock Exchange Group. Meanwhile, a cabal of UK MPs have come out against the UK regulator. The FCA is under fire and management may be in the firing line. A committee of MPs have found the Financial Conduct Authority is incompetent at best, dishonest at worst. Gosh, things could be regarded as somewhere at the coyote stage of ugly, I think, when you hear those such remarks from a group of parliamentarians. It's another element of the UK government machine looking rather unfit for purpose, alas. I do wonder if Elon might bring his unique Doge concept to GB government soon. It could certainly do with it. However, onwards and upwards to a much more exciting and uplifting topic today. Our guest is Shiloh Bates. The topic, bringing CLO to your investment flow. Don't know what CLO is? We'll get to that in just a moment. Shiloh Bates CFA is a partner and chief investment officer at Flatrock Global, which he joined in 2018 and is the Chief Investment Officer, as I say. Before that, he was a Managing Director at Benefit Steel Partners, where he worked in corporate acquisitions. Before that, he was head of structured products at BDCA Advisors, where he was responsible for investments in CLOs and leveraged loans. During his 20-year career, Shiloh has worked at various CLO managers and is a frequent panelist at CLO conferences. He wrote the book, CLO Investing, with a focus on CLO equity and BB notes. He's a lifelong learner, and he's here today to educate us in, well, the wonders of the CLO world, although I also have to say, fascinating footnote, he was a specialist in psychological warfare in the US Army Reserves. Shiloh, welcome to IPO-VID, episode 162. Where in the world are you today?
Well, it's great to be with you, and I'm in Nicaragua today. So I'm down here surfing. It's our week of Thanksgiving, and the waves in Nicaragua are great, and the sun's out. And Nicaragua features very consistent, uncrowded waves. So that's why I'm here.
What a fantastic way to celebrate Thanksgiving, something completely different. I'm not sure you'll get your turkey dinner, but whatever you do, certainly the prospect of those sensational Pacific waves has got to be quite sensational.
Absolutely, it is. Yeah, I've already enjoyed it. I already went out this morning and caught some great waves.
Good for you. Well, thank you very much for joining us after your morning surf. It's really a joy to have you during this week of Thanksgiving. Let me also add, by the way, a very happy Thanksgiving to all our viewers this week. I think if nothing else, the US ought to give Thanksgiving for, gosh, one simple fact. 2008, I do believe that the US economy was roughly worth $15 trillion. At the same time, the European Union's economy was worth roughly $14 trillion. Fast forward 15 years and the US economy, well, actually the European economy, entered 2024 at $15 trillion. So it had grown to the same size as the US way back then. The difference is the US was at $27 trillion. Now, tell us a little bit here. I mean, CLO, You talk about this all the time. Perhaps you can give, some of our viewers are going to have a good idea about what it is, but give us a basic definition of what CLO stands for and what we're talking about here.
Sure. So CLO stands for collateralized loan obligations. So today in the US, this is a $1 trillion asset class. And basically each CLO is about 500 million in size, and its portfolio is composed of 200 plus first lien senior secured loans. So the loans are created in leveraged buyouts. So imagine Ares, Apollo, KKR, they're buying a company. They believe in its prospects for growing revenue and cash flow over time. They might put up 50% of the purchase price in equity, and the remainder is financed with a first lien floating rate term loan. And so these floating rate loans are spread amongst different CLOs today. And the portfolio of the CLO, again, 200 different of these first lien loans. The loans are rated generally like single B or B2 from Moody's, S&P, and then Moody's. And then the CLO finances itself by issuing long-term debt, some of which is rated AAA, which has the first claim on the CLO's cash flows. And then there's AA, single A, triple B, double B, and down to equity. At FlatRock, we specialize in the double B tranches or double B portions and the equity portion. So the simplest way to think about a CLO is, if you bought stock in today, Bank of America or JP Morgan, you get exposure to dozens of different business lines. But the CLO is just a pure play lender. So its portfolio is, again, these first lien loans, it finances itself at a very attractive rate, which enables the CLO to be profitable. And then that profitability is distributed to the CLO's equity owners on a quarterly basis. So it's a simplified bank is basically the way I would think about it.
Okay, so very interesting. I mean, obviously you're dealing there then mostly with investment grade securities all the way through, or investment grade loans. How can we think about this in terms of just how secure we are? You've made a couple of mentions about it in terms of the hierarchy. In the event that a deal goes badly wrong, and good grief, I don't want to mention anybody because it sounds like I'm jinxing them, but some titan of private equity gets a deal wrong and it all goes south. Where are you sitting then in the overall mix in terms of getting your money back, or at least having a creditor's claim against the assets?
Yeah, sure. So in CLOs, there's two different things that are rated. First thing is the underlying loans, which are the CLO's assets. So those are rated speculative grade. So again, B2. But the CLO sells securities where those loans are pledged as collateral. So the liabilities, if you will, of the CLO are going to have different ratings from AAA down to double B and then equity. And so your question, how do you lose money in CLOs, or how do you get stuck in a bad trade? Well, one way to kind of think about it is that at FlatRock, we've looked at every CLO that was issued from 2000 to 2022. And so we stopped it at 2022 because we were looking for CLOs that have kind of run their full lives. So a CLO has a useful life of about 8 years or so. And like when we looked at returns for the equity tranches, so that's the equity owners of the CLO are in the position where they're taking the most risk and they're looking for the highest return. The probability or the historical outcome, if you ask just what percentage of CLOs have a negative IRR, it's about 5%. So very few CLO equities have had negative returns. And then if we're talking about CLO debt securities, so the CLO double B note is the most junior debt security that's issued. If you look back over 30 years, that has a default rate of about 25 basis points per year. So it's basically a de minimis default rate there. And then as you could imagine, as you talk about CLO securities that are more senior, like the AAA, for example, there's never been a default in the 30-year kind of history of the asset class.
Very interesting. So Trying to understand this and just break it down, because there's obviously a lot of jargon in there. Our super professional readers are lapping it up, and our viewers are lapping it up and absolutely loving this. And by the way, if you love this, ladies and gentlemen, give us a little bit of love. Would you give us a heart? We're here talking about bring CLO to your investment flow with Shiloh Bates. It's a fascinating conversation altogether. Who are the sorts of people that traditionally have been buying either? Your specialty is what CLO equity and triple B notes.
Sure. So again, the CLO has 500 million of assets in it. This pool of leverage loans, and then securities from AAA down to BB, and then equity are sold. And it's different buyers depending on which portion of the CLO we're talking about. So if we're talking about AAA and AA rated notes issued by CLOs, those are going to be bought by banks and insurance companies. Japanese banks are one of the biggest buyers there. And then as we start talking about CLO securities that are more junior in their in their security claim or in their priority in terms of payment, then those are going to be bought by folks like me. So managers of interval funds, hedge funds, alternative asset managers. They also find their way into GPLP funds that are private. So it's kind of a mix of people who buy these different securities. But one of the ideas in CLO investing is that we think the overall pool of leverage loans is very attractive. But by using securitization, you can decide. You could say, hey, I'd like to own the riskiest exposure to this pool of loans and get the highest return. You can do that. If you want to be more senior in the securities that are issued by the CLO, you can get something that's investment grade, and that might fit your kind of investment mandate. So there's kind of something, if you like leverage loans, there's a CLO security that's issued by the CLO that probably fits for most of your podcast viewers.
That's fascinating. Okay, so give me also then just a flavor about your own fund. I'm not asking who the investors are, but what are the kind of people that are invested in your fund currently?
Yeah. So at FlatRock, we have two CLO focused funds. One invests in CLO equity and the other invests in CLO BBs. And our investors are RIAs. So in the US, if you give your money to a financial advisor and you tell them, I'm not sure, what kind of stocks I should own or what percentage of bonds should be in my portfolio, they might have a model, and our funds would be part of that model. So, our equity fund might be 5% or 10% of an investor's portfolio. They probably don't know FlatRock. They don't have a relationship with FlatRock, but there's a chief investment officer type function that's done by the RIA, and then that person is responsible for putting hundreds of their clients into funds like ours.
Fascinating altogether. And you mentioned, and I'm jumping around a bit here, Shiloh, because there's so many fascinating things to talk about. And thank you very, very much to the person out there who's already given us a lovely heart and some love. It's great because AI loves love. It's the way to manage to get this show higher up in the overall ratings, ladies and gentlemen, and therefore more people can see it. And we can talk more about the fascinating opportunities of CLO investing and bringing it to your investment flow. So, Shiloh, I am jumping around here a lot. The overall CLO market, you mentioned that it's $1 trillion business, which is quite something. That puts it in the top 7 or 8 equities, as it were, in the United States of America, in the world, in fact, as a single investment class. What has been the direction of travel of CLO in recent years? Is the actual amount of issuance expanding?
Yes. When I joined the CLO market, this is a little bit over 20 years ago, and there were a handful of CLO managers, and there was about 6 billion of AUM. And so every year I've been in the business, we've seen growth. There was a pause of CLO issuance during the financial crisis. I'm happy to talk about that. But generally, it's been like just kind of a hockey stick upwards. And there's a few reasons why I think people like CLO securities. So one is they're floating rate. So there's no interest rate duration. Two is that the historical performance is really quite good. So imagine if you're investing in CLO double Bs. I focus on middle market CLO double Bs. There's a little bit of a nuance to it, but today they pay a floating rate 3-month SOFR in the US, that's a floating rate that's pretty heavily tied to the Fed funds rate, plus about 8%. So you're talking about kind of low teens kind of yields for CLO double Bs, and the historical track record, again, this 25 BIP, almost a de minimis default rate, really. And so it's the historical performance of CLOs combined with the fact that they're floating rate, and investors just see it as a better way to get exposure to like actively managed pools of first lien loans that they think are attractive. And as the Fed, here began hiking in 2022, the income from loans and the income from CLO securities went up, with the Fed hiking, and so that created returns that were, for securities issued by the CLO, that in many cases would be a very good equity-like return, except that we think you're taking a fraction of the risk that you would be taking in equity. So the good performance is certainly a big factor, and what I think is kind of one of the hindrances to CLO issuance is just education. So the CLO market it's not plain vanilla. CLOs are not as easy as buying a stock through your Morgan Stanley account or buying a investment grade bond or over the counter. There are some nuances to CLO investing, and in my experience, when people do the education and spend the time, then they can get very favorable risk-adjusted returns, and it's worth their effort.
Fascinating altogether. So let's just get that right. You're looking at something like low teens returns for these per annum, something like that?
So it depends on which security we're talking about. So the CLO AAA would offer obviously the lowest return, and the person in investing in CLO equity, that's the person taking the most risk. They're targeting returns in kind of like the mid-teens. And so what generates the CLO equity return is just that the CLO's loans, its assets, have a higher interest rate or higher yield than the CLO's financing cost. So just like a bank, the loans yield more than the bank's financing cost, and that's what generates the profitability for the CLO equity investors.
That's certainly a pretty spectacular number. I mean, that's like sort of looking at deposit income in the early 1980s, before the US stock market bubble or boom of the last 40 years really started to take off. I mean, that's a remarkable number altogether, given the fact you're talking about really only relatively small amounts of risk. However, I mean, you mentioned, first of all, there's obviously a degree of specialized knowledge involved in this. And I'm sure the paperwork that you have to troll through when you're doing your due diligence is somewhat eye-popping, because I'm sure they don't manage to produce 5-page teasers that tell you everything you need to know about any investment. Yep. So that's why people obviously are going to managers like you. But I mean, when it comes to buying these bonds, how are they issued? They're all being traded, essentially being issued by a bank underwriter and therefore sold to institutions only, yeah?
Sure. So each CLO has a CLO manager. So that's the person who picks the initial loan pool, the person who keeps the CLO fully invested during its reinvestment period, and makes sure the CLO is passing its many tests. And so that person, firms in the US that are big in CLO management are really the publicly traded alternative asset managers. They all have big CLO management groups. But the person who really brings the CLO to life is an investment bank. So they have a mandate. For example, let's say they're doing a new CLO for BlackRock. Then what the bank's mandate is to get investors to sign up for the CLO. So all the different debt investors needed, from AAA down to BB, and then the equity, to get them to all agree on the terms of the CLO along with the manager. That's their job, and the final product there is to print trade tickets where these securities are issued 144A, so it's not a formally registered offering or anything like that. And they're sold to just really like a handful of investors. So there's not a wide process for a lot of these securities. So imagine CLO equity might be the total size of the investment in a CLO might be 50 million. And so usually that's offered to a couple guys like myself and is kind of got, and we take it, right? So it's not a process where investment banks are going out and looking for lots of new folks to bring in. They do a lot of education, and occasionally they'll find somebody who they think will be a sizable player over time and invite them to participate as well. But the end security is a 144A bond, so unregistered that you own.
So if they're issuing to a relatively small pool of investors, I'm just curious, how do they arrive at an offer price? I mean, are they just starting from the AAA tranche and then sort of pricing according to that series of parameters or a formula?
Yeah, so let's start at AAA. So the CLO AAA represents almost 2/3 of the CLO's financing costs. So the rate's very important. So what gets the CLO a better rate would be working with a CLO manager that's very well known by the market, that has a good track record of managing the loans, and somebody who probably issues 3 or 4 CLOs a year. So they're just kind of constantly in the market. And in Japan, where they really like CLO AAAs, and these are dollar denominated, by the way, but they like them still in Japan. The Japanese have approved lists, so they have like 10 or 15 guys that they like to work with. And so they negotiate that rate, the AAA rate, with the bank and the manager. And then once that's set, other investors in the CLO who are maybe less important, and by that I mean just the size of their investment is going to be smaller, AA down to double B. The investment bank that's bringing the CLO to life, they manage that process, that negotiation. And then usually CLO debt securities are issued at par. So we're just really talking about the rate, that the floating rate that the CLO debt investor is going to get paid over time. And then the CLO equity is a little bit more of a negotiation. So how I look at it, and I think my peers look at it, is we're kind of solving for a return that we think is fair or adequate in the market. And so if we're solving for mid-teen returns, we project out all the projected cash flows of the CLO to the equity, and we discount those back and kind of solve for a price doing that. And then there's a little bit of a negotiation there with the bank and sometimes the manager of the CLO as well.
Fascinating, really, really fascinating. And so tell me, I mean, you mentioned the fact that it's a relatively small pool, actually at all the tranches, I mean, a relatively small pool, say, compared with public equity or even US Treasury bonds. What happens in the event of somebody looking to try and move one of these CLOs in the secondary market? Is there much of an operation, or does it fall back on the original issuing investment bank, or is there an interdealer broker? How does that work?
Sure. So in my market, a lot of CLO securities are traded using this auction process. We call it a BWIC. So that stands for bids wanted in competition. So say I want to sell a CLO security. It might be, the total size of the total tranche size might be 50 million. Say I own 5 million of it. Well, one thing that really aids the market in terms of liquidity is that all CLOs are modeled in software called Intex, which is broadly used by market participants. And so for each CLO using Intex, I can quickly see, how the CLO is performing, what expected payments are coming, if there's any loans that have defaulted or are dinged up. And by the way, usually there's a few. So these are speculative grade loans. So they do occasionally default. That's expected. that's expected in my business. And so with the aid of Intex, people really can see quickly, all market participants, how a CLO is doing. And so I might say, I'm looking to sell this $5 million piece of a CLO, 2 business days from now. And I communicate that to all the investment banks that I know of that kind of trade in these securities. And then they take that information and they blast it to their clients, and they say, they don't say who the firm that's selling is. It's private, but they try to kind of rustle up the best bid for that security. And then, say 2 business days from now at noon, I get a bunch of bids through the investment banks and decide if any of them kind of warrant selling or not. And so that's really the process that most people go through. You can also just call up an investment bank, and they will likely bid a CLO security for their own book without having an end buyer lined up. But in my experience, the auction process is what we would use to buy and to sell our CLO securities.
Fascinating. So it's got everything that it needs to be a market there, but obviously one of the issues is always going to be relative liquidity, because there are not that many players around. But nonetheless, you're not in the business of buying and selling these securities. Presumably, you're in the business of buying them and endeavoring to hold them for as long as possible, if not all the way through to their maturity.
Yeah, that's right. I mean, we will do some trading to optimize our portfolio, but in general, we're buying CLO securities with the intention to hold them for an extended period of time. When you invest in CLOs, there's and now maybe just talking about the equity tranche, there's both the cash flow that you get on a quarterly basis, which today CLOs distribute in kind of the mid to high teens. So you're getting a lot of cash flow from the CLO. But there's also some events in the CLO's life that can happen, which can increase your profitability over time. And one of those is just the CLO equity has the right to refinance the CLO's debt at lower rates over time. So not right out of the gate. When the CLO forms, there's generally like a non-call period where you can't kind of tinker with the CLO's financing for 2 years. But after that, if it's to your advantage as a CLO equity investor, if you can save some of the interest expense, you go into the market and you do that. And there's some real upside to CLO equity investors when they can get those done.
And also it's interesting because you're talking about this and I'm just listening to this. So there's a kind of a hybrid flow as well, which, I mean, we don't need to get into the minutiae of tax, but it must be quite interesting for some kinds of investors, because presumably on one side, they're getting what is effectively income. On the other side, they're allowed to make themselves some form of capital gain when they exit the position.
Yeah. So what we see in our funds is that it's almost all ordinary income is what you get from these investments. So there's not, unless we're in a really dislocated market, which we're not at the moment, you basically get the carry, the cash coming in from the CLOs, but there's not a huge ability to build capital gains into the portfolio. And so for U.S. investors, that means that CLO securities work well in tax advantaged accounts. Mm-hmm. And if the account is fully taxable, then the CLO's income is just taxed at the investor's marginal income rate.
Okay, so that's going to be very, very attractive, which presumably therefore brings us back in whole or part to one question I was going to ask you, which was, that's very interesting that a lot of your clients are ultimately ending up with RIAs, because presumably those are exactly the sort of people who are looking to gain from that sort of tax advantage upside.
Yeah, that's right. Another way to think about it would just be, if you're investing in like the S&P or some publicly traded equities, as you know, the S&P has a very low dividend yield. And so, all the return really comes from capital appreciation. Where in CLO securities, all the return is really coming from cash income that you're receiving from the CLO. And for, a lot of people with, cash needs, that's kind of the superior, they view that as the better way to get the return, actually just having the cash.
So it's interesting because before we go to the sort of our midpoint break, I'm just curious, when it comes to the CLO business as a whole, are the issuers predominantly American, or are you seeing issuance of CLO coming from all around the world?
So I only focus on U.S. CLOs. That's the biggest market, and again, like I said, it's 1 trillion. There are a lot of CLOs that are issued, in euros, and the underlying loans are, from companies, in the EU and UK. But that's not. It's a smaller market, and it's not one of my focuses.
But it's a perfect answer for me, Shiloh, because it allows us to go to our short video of the week. We're going to give you a moment to have a little bit of a rest and drink some water and prepare for the second half of the show. We're here talking to Shiloh Bates about bringing CLOs to your investment flow. Fascinating topic of conversation so far. But meanwhile, ladies and gentlemen, can the European Union adapt to new challenges? The Union faces a wake-up call as President Macron, Mario Draghi, and others confront its stagnation and vulnerabilities, especially with incoming President Trump's demands for NATO funding and the possibility of a tariff war challenging its stability. Here's a short video we made, which you might enjoy watching for the course of the next 60 seconds. Meanwhile, in Big World, Syria may not be in the European Union, but Emmanuel Macron is on the road to Damascus. That's the way we talk about it in the English language when someone's undergoing a huge change of thought. And the realization of the European Union is just how weak the European Union actually is, or at least amongst some of the leaders. The President of France, Emmanuel Macron, former Prime Minister of Italy, he's just written a very, very long report, Mr. Draghi, they are deeply concerned and they're terrified at the moment. Why? Trump's coming in, he's going to want tariffs, he's going on Europe to pay its way with NATO, and that scares the European Union. Because what's the biggest problem here? The biggest problem is the European Union is proud and wonderful and incredible and believes that it's the scintilla of all things perfect. And it isn't. Remember those growth numbers. GDP, 9% over 15 years, 86% growth in the USA. The European Union has nothing to be proud of. It needs to change and it needs to adopt for the Trump trade. For more in Big World, like or follow. And of course, if you're looking for all of the news about the world of exchanges, don't forget to subscribe to the Exchange Invest newsletter for the latest news updates. You can go to exchangeinvest.com. If you're not into the bourse business day by day, and well, I must say you're probably living a very cloistered and boring life if you're not interested in the business of bourses. Nonetheless, don't forget you can sign up for our free weekend newsletter, which is much more of a macro read. Some fascinating topics in there. Again, drop by exchangeinvest.com and have a look at that. This week's book of the week, actually, we were talking about this book just a couple of weeks ago on this very show. Mellow Your Money, How to Surf the Market and Build Wealth Without Stressing Yourself Out. How apt that we're talking about a book about investing relating to surfing at the same point in time, as indeed we've got our current guest, Shiloh Bates, in the wonderful nation of Nicaragua, surfing himself. And we're glad that we can manage to get you out of the water to join us for this conversation about bringing CLOs to your investment flow. Shiloh, anyway, Mellow Your Money, How to Surf the Market and Build Wealth Without Stressing Yourself Out is an impeccably interesting read from a very, very different kind of fund manager who is fundamentally laid back, but good at catching those waves, whether in life, markets, or indeed on the surf. Don't forget, ladies and gentlemen, once again, Exchange Invest, only $499 per annum to join the exchange of information and help pay for us to produce these sorts of live streams and podcasts, etc. Now, back to our guest, Shiloh Bates. Today, we're talking about bringing CLO to your investment flow. Fascinating conversation altogether. So you were talking about the rest of the world market, which I appreciate you don't specialize in per se. You're interested in the US $1 trillion market. When you're looking at that whole business, just to clarify one thing, you mentioned, I think if I remember correctly, that roughly the average life of these securities is around about 8 years, something like that. Presumably that's related to the fact that the people buying it are coming out of private equity funds, and therefore those mostly got about a 10-year kind of life cycle themselves.
Yeah, exactly. So the CLO is formed, and usually it has a 4 to 5 year reinvestment period. So during that time, the loans that are in the CLO, they're constantly prepaying, and the CLO manager is going into the market and they're buying new loans with the proceeds of the prepayments. And then once you get to the end of the reinvestment period, as loans repay at par, the CLO manager takes those proceeds and they, instead of buying a new loan, they use the proceeds to pay back first the AAA and then the AA. So the CLO really is never in a position where it's forced to sell the loans that it owns. Rather, as loans repay after the reinvestment period, the CLO slowly delevers. And then at some point after the CLO has begun deleveraging, the equity distributions decline because you're losing leverage and you're losing your best funding cost. And then at some point, the CLO equity investors will decide to liquidate the CLO. So that means selling all the CLO's loans and repaying the debt, and then the equity gets the remainder. And then the reinvestment period, that's kind of driven by ratings. So you can't, the shorter the reinvestment period means for the CLO debt investors, less can go wrong. So shorter period of time, less potential calamities along the way. And so the reinvestment period is actually driven by rating agency constraints. So Moody's and S&P have a say in how long the CLO can continue to reinvest its prepays. And 4 to 5 years is generally the answer there.
Okay, that's very, very interesting. So thank you very much. You mentioned earlier how obviously with the equity tranches, there's an issue because the exciting thing is, at least at the start, you know exactly what you're going to be getting in terms of your cost and your interest payments and so on, but those could change over time. So it's a fascinating and dynamic business. I can see obviously why there's a need for intermediation from expert managers such as you in the middle of it. But the whole topic today is like bringing CLO to your investment flow. Now, I can understand how if I'm a family office in Zug or somewhere like that in Switzerland, that I could see, oh, this looks really, really interesting. It's a fascinating opportunity for me. It compares to a lot of other possibles in my portfolio and can correlate very, very nicely. Are you finding that there is CLO interest trickling all the way through the investor mindset? I mean, from the top of the institutions who are already there through mid-tier institutions, but is it actually reaching closer to Main Street than Wall Street?
So I think it is. And so I'm a manager of interval funds. So again, my funds are CLO equity and CLO BB. So many institutional, non-institutional investors, kind of mom and pops, are investors in my fund. But the even bigger portion of the market that has gone to retail is ETFs, so exchange traded funds, managed by a Janus or a Panagram. These funds have seen big inflows. They buy CLO AAAs in some funds. They buy CLO down to CLO BBs in other funds. And there's just been a lot of growth there, and investors are finding them interesting because they're floating rate, and we're in this cycle now where the Fed is cutting, but rates are still elevated versus where they've really been over the last 10 years, or basically zero was SOFR or LIBOR in 2021, and so investors are taking advantage of the higher base rate. They're looking for exposure to first lien loans, which are secured by all the assets of the company that default rarely. And when the loans do default, historically the recoveries are about 65%. You get your money back. So loans have been a great asset class over time. The CLO securities that are backed by those loans, have performed very well also. And then just kind of the question for investors is, would you like to own a CLO AAA and sleep well at night knowing none have ever defaulted, or would you like to take some more risk and potentially or theoretically earn a higher return and sit in a more junior security that's issued by the CLO? But we're seeing a lot of investors in these ETFs. They're taking market share. In a lot of cases, I think they're taking market share from cash. So people kind of see, a CLO AAA ETF as a substitute for cash, just higher extremely low probability of default in a AAA, and much higher income than cash in an investor's portfolio.
Yeah, and certainly I can see how it's attractive compared to quite a lot of, say, note and bond rate returns of a similar sort of duration. There's a possibility there. Now, ladies and gentlemen, bear in mind, we're not trying to advise you to buy these things. Please do your own research if you're a retail investor. We're just here to have an adult's conversation about how interesting a particular sector is and what's going on. And we're delighted that we've got Shiloh Bates, one of the leading money managers and specialist tranches in this field, talking about bringing CLO to your investment flow. So Shiloh, it's quite fascinating though, the arrival of these ETFs, I mean, presumably that also means that there is the possibility of greater capacity going forward if the CLO market is going to grow exponentially further.
So that's exactly right. So there's more buyers for CLO securities. That should mean more issuance of CLOs. But the one kind of the one thing that has kind of put the brakes a little bit on growth is that the underlying loans that are in CLOs, they're formed again in leverage buyouts. So a private equity firm's buying a company, putting up half the purchase price in equity, financing the rest with a first lien term loan. Well, what we saw in 2022 and really beyond is that as the Fed began hiking, it was LBO activity went down substantially. And so private equity firms were not able to find companies where they could agree on a price with the seller and finance, half the purchase price with the first lien loan and kind of have returns that pencil out to probably 20% or better. So that's what the private equity firm might be targeting. And as rates went up, it was really kind of hard to make that math work. And so we haven't seen a lot of new issuance of loans. And that's kind of that's the fundamental building block of CLOs. And without that, basically you have a CLO market that's grown quite a bit. But at the moment, it's kind of stagnant in terms of total AUM.
Right. So the total AUM is kind of stagnant. And in order to move forward, what needs to really happen to therefore kickstart that market?
Yeah. So I think what will happen is as rates come down is that it'll be much more attractive for private equity to deploy. The private equity firms have a record amount of dry powder. So they raise a lot of money. It's waiting to be called, and they haven't found appropriate investments for it yet. So, one estimate I've seen of the number, it's like 1.5 trillion or a little bit higher. So there's lots of money waiting to be deployed. And as soon as private equity firms identify, good targets and take advantage of the fact that loan financing rates have come down as the Fed has cut twice now, I think that's kind of what you need to happen, what needs to happen for the market to grow. And we're seeing some signs there, but nothing dramatic yet. But we're seeing kind of the early shoots of that kind of recovery.
Okay, and are there any particular regulatory threats on the horizon that could damage the CLO market?
So there's no regulatory threats to the market that I'm aware of or that are focused for me. Occasionally, there's some nuances to rules around reporting and some other things but no, there's not. The market's been around for a while. I think regulators are happy with its transparency and its performance, and we're not expecting any big changes there.
Okay, and it's interesting because obviously during the low interest rate times, one thing we didn't see was corporate defaults in any way, shape, or form. We've now had interest rates going up for quite some time. Okay, yeah, they're coming down again, but for those who are paying off their bond debt, a lot of people had to refinance and end up with somewhat higher coupons as they were going along. Has there been any kind of impact so far, or do you see any signs of stress in terms of companies that are with leveraged loans that may be defaulting in the CLO market?
Sure. So an investor in CLOs, they look at this portfolio of 200 plus loans, and they know some of them are going to default, and they kind of budget that into their expectations. And so for the most part, I think most people who buy CLO equity, they assume that 2% of the loans will default each year, that the recovery will be around 70 cents on the dollar. And if you look back over the last decade, there's like a bunch of data for CLO loans that would support that. And I think for the most part, like people's CLOs are kind of tracking to those expectations. Now, the one kind of like challenge we have in the CLO market is that, whenever you see kind of a reported default rate for leveraged loans, a lot of times that's going to be for the entire loan market, which is like around 1.4 trillion. Well, CLOs actually own a very conservative slice of the loan index. So there's lots of players in leveraged loans that have different mandates than the CLO. So if you're like a business development company or you're doing high interest rate loans, a lot of those just wouldn't be in CLOs. And so when somebody reports to you a default rate, then that's not like you just care about what it is in CLOs, and nobody actually reports that metric. So, I could tell you like the default rate in our CLOs is sub 2%. And that's a rate where everybody feels good, from AAA down to equity. As interest rates went up, you're right, there's been this higher interest rate burden. You would have thought that would lead to more defaults, but actually businesses kind of use COVID as a time to, come up with efficiencies, automate more processes, do less with humans, more with the web. And so businesses have become more efficient. They've grown their revenue and have been able to make the higher interest payments with the higher rates. There's like a handful of companies, and again, obviously rates are going down from here. And then at least that's what's been happening, and it's the current expectation going forward. But there are some companies where the higher debt burden mattered, and we'll see some defaults, and that's part of the business in my asset class.
So in other words, the secret sauce you're telling us is your ability to manage to endeavor to keep yourselves around about that sort of 2% default rate, which presumably is enhancing returns to your customers.
Yeah, so a 2% default rate should result in like a mid-teen equity return for CLO equity, and a 2% default rate results in zero defaults for any CLO debt securities from AAA to BB. So that's the market performs very well at a 2% default rate.
It certainly sounds like it. It's a very, very interesting prospect altogether. So as you look at the CLO market going forward, is there anything that's likely to change given the fact that there's obviously a regime change now taking place in Washington, D.C.?
So no, I think my market is not affected by the change in administration. There's nothing coming our way that we think changes anything.
Interesting, very interesting altogether. And in terms of the CLO market as a whole in the US, where do you think it's going to go? Is it a situation where you're going to see that recent lack of issuance being made up during the course of the next few years if interest rates go down? Are you looking at a lot more entrants? What do you think the dynamics are going to be?
Yeah, sure. So I think in the next year we will see a lot more loan creation. And with the new buyers, the CLO ETFs that we talked about, I think that'll mean a lot of new CLOs are created for sure. And then also, I think our asset class has done a really good job or a better job, I'll say, of just educating people on the relative attractiveness of CLOs. So like last year, I published a book on CLO investing. It's on Amazon and Barnes & Noble and elsewhere. And there's podcasts on the CLO market now, of which I have one as well. And I think for many years in CLOs, just the favorable risk-adjusted returns were not matched by the educational effort of people in the asset class. And I think that's kind of changed now. And so it's much easier to come up to speed on CLOs today than it was in the past. And I think that'll mean, again, more investors into the asset class.
Interesting. And do you think is there likely to be any change in the structure of, say, CLO issuance and trading? Is it going to get more digitized, or is it just, relatively speaking, too few issues to make much of a difference?
So I don't think it lends itself to being to more digitization, if you will, just because imagine, like in the CLO pieces or portions that I focus on, the total size might be 50 million or less. There's three or four owners of the security, and it's going to trade, maybe once a year or something like that. So it just doesn't. The auction process that I described earlier, it kind of works well for that. I think there are firms that are trying to make the trading more electronic and easier, but I think people, like for a firm like mine, we don't do enough trading. Like for the amount of trading we do, the current system works for us just fine.
Fascinating. So therefore, that brings us, I think, very elegantly after that amazing tour de force all the way around the whole concept of CLOs and bringing CLO to your investment flow. Shiloh Bates, where do you think the capital market revolution goes next?
Yeah. Well, the revolution from here, again, I think it's just, increased exposure to CLO securities for lots of different investors. So historically, again, it was institutions that were the primary investors in all CLO securities, AAA to equity. And now with the growth, again, of ETFs, of interval funds, more and more investors are targeting these securities. They like the risk-adjusted returns. And oftentimes, their financial advisors recommending these securities. And for institutions, I still come across many who are large and sophisticated and, have just allocated to, say private equity, and are kind of, now thinking more about private credit and CLOs. And I talk to, a lot of these people during my day, and I think a lot of them are going to come around to investing in CLO securities over time. So I just think it's the proliferation of CLO securities into lots of different investors' portfolios is the revolution I'm seeing.
The proliferation of CLOs into everybody's portfolios is a massive revolution to come. How exciting, ladies and gentlemen, particularly with those sorts of potential for very secure but decent returns all the way through to ever so slightly risky but seemingly relatively interesting, but nonetheless low teen to mid-teen returns. Quite fascinating altogether, whether you're in the debt end of this horizon or the equity tranches. It's been a joy today to chat to Shiloh Bates and talk about bringing CLO to your investment flow. Check out Shiloh's book on Amazon or wherever good books are sold. Ladies and gentlemen, a fascinating insight into the world of the CLO business. That's going to be our show for today. Of course, no show this week could be complete without wishing everybody in the United States of America a very, very heartfelt happy Thanksgiving. I hope you have a fantastic day. To all of our American viewers, listeners, readers around the world, and when we come back from Thanksgiving, it's going to be time for IPO-VID 163. And we're back, ladies and gentlemen, with the year in review. It's going to be part one on December the 3rd, same place, same time, 12 o'clock Eastern time. We're going to be running through some of the most interesting discussions about the capital market revolution during the course of the 2024 year. And that's going to be starting to wind up our season as we look towards the end of the year. In the meantime, let me say once again a huge thanks to Shiloh Bates for being such a terrific guest today, bringing CLO to your investment flow, and also the dogged and wonderful production team today. Thank you very much to Desiree, to Herminia, and Marianne for making this IPO-VID 162 such a memorable show. My name is Patrick L. Young. If you're looking to have an exchange built out there at any point in time, let me know. We're taking commissions for 2025. And if not, I hope to see you in Exchange Invest every day, the water cooler of the Bourse business. And now, Before I say adieu, I just want to say I wish you a great day of fantastic and happy surfing for this Thanksgiving week. Shiloh, thanks for being such a terrific guest. My name is Patrick L. Young. We'll see you same place, same time for the first part of our review of the year next week. I look forward to it, ladies and gentlemen. Don't forget, you can catch all the exchange news at exchangeinvest.com. Have a great week in life and market.